Buzzer, please. And the data says 214,000, which is down 1,000. Although, if you have a good memory, you remember it was 214,000 last Thursday, and indeed it was. We upgraded that to 215, so down one. On continuing claims, just slightly lower from 1.631 million to 1.623 million. The feature today, dollar index getting its mojo back after, it was one of the markets. Obviously, yesterday the equities had a big response to the midterms. Dollar index was hit back a bit. You saw many Asian and emerging market currencies rallying throughout the week against the dollar, reversing 2018 trends. But it is now back above 96, which seems to be a good litmus test for bull and bear boundary territory. Of course, as we all await not necessarily anything with regard to Fed action, but of course the statement maybe offering clues into 2019, or for those who think that maybe December is not on the table, probably will dispel some of those thoughts. Andrew, back to you.
Okay, Rick, thank you for that. I want to get over to Steve Liesman. He joins us now with more, also an early look at this afternoon's Fed decision. Steve, at least in terms of this afternoon, I imagine we're not going to be hearing much, but curious if these numbers do anything for you.
Well, I mean, of course they do something for me. A low number of Americans filing for jobless claims is a good thing. It speaks to a strong job market. It speaks to a strong economy that, by the way, because we've been so focused on the election, haven't really had a chance to talk about. The economy is slowing, but not to a slow rate. We will have done 3.6 GDP in the third quarter, and our CNBC rapid updates running 3% in the fourth quarter. So that's a good number. That's a point above the potential growth rate. So slowing, but not slow. Let's turn to the Fed now, take a look at what the Fed expectations are for today. 90% of our survey respondents say no rate hike. So agreeing with Andrew right there and pretty much everybody out there in the street. 90% no rate hike, but 85%, a pretty healthy percentage, 30 respondents this time, saying there'll be a rate hike in December. And there's that 2.5 for 2019. That tells you that everybody pretty much agrees on 2, and half of them say 2, and the other half say 3 for 2019 in total. So we put it all together. We did the math for you. What does that mean? It means we'll end the year at a 2.4, go on up to 3 for next year, 3 for the year after that. And you can see also there what the FOMC projection is. A bit of a disagreement on 2020, but hey, we got time to work that out for 2020. But right now, 3% is the average estimate for the Fed funds rate next year. We did ask people, what about the balance sheet reduction? The Fed next year, if it stays on track, will reduce the balance sheet by $600 billion. So we asked folks, what's that worth in basis points? And 15% said it's less than 125 basis point hike. 32% say it's worth 1 hike, and 32% say it's somewhere in the 2 to 3 hike range. The average is 35 basis points. So whatever you think is going to happen, you might want to add that on to what the balance sheet reduction effect will be on interest rates. One other thing we asked about, which is what is the effect, why did the recent stock sell-off happen? And concern about more Fed rate hikes was our number one reason there. Tariff concerns in the second place, and higher market interest rates in third place. Other factors were the earnings outlook and concern about U.S. and global economic weakness. A couple quick commentaries here. John Cotter, Chief Investment Officer at Arden Asset, writes in, at the moment, the Fed is more concerned about strong employment and wage growth than stock market turbulence. Gradual tightening and balance sheet unwind will continue. And Ed Keano, I think we had on just recently, chief investment strategist, saying the Fed would be wise to pause in 2019, absent clear evidence of higher inflation. The neutral rate might be lower than current analysis suggests. Much higher rates might needlessly increase recession risk. So, Joe, a range of responses there, but in general, they think the gradual rate hikes continue next year with a debate of 2 or 3, and then we also have to eventually think about what that means, the Fed reducing the balance sheet by $600 billion next year, Joe.